Good day traders, welcome to this week's video. My name is John Jacobs for RMDTRADER. This week we continue with part 2 of our educational video explaining our 5-phase trend evaluation method. And we look at how exactly it can be used to increase your win rate as a trader by identifying those high probability trade setups. If you missed part 1 of this video, please go and watch it now. You can find the link in the description below. That concludes the formalities, so let's get charting. Welcome back to part 2 of this video. In our previous video, we showed you how to identify the 5 different phases of our trend evaluation method and also what the important key events are that you should be looking at to identify each new phase. So perhaps just to recap, let's just quickly have a look again at the 5 phases and also what those events are before we jump into exactly how we should be looking to trade in each of the different phases. So the first phase, called phase 1, our initiation phase, is where we would typically see price breaking through our 200 daily moving average. The next thing we would be looking for is we are looking for the 200 simple moving average to move in between the 50 and the 100 simple moving average. Once this occurs, we are now looking for a break in trend structure in terms of if we are looking for a new downtrend to be established, we're looking for price to either break through a structure to the downside in terms of something like a diagonal break or a horizontal break, which is probably more ideal. This then allows us to move into phase 3, and phase 3 is where we're expecting price to pull back towards previous market structure or one of these MAs, and then continue to break lower and then pulling back to retest a previous market structure or MA and continue doing that until it reaches the maturation phase. Now, not all markets reach maturation phase. Some markets are cut down in the prime, or some trends are cut down in the prime of their life, and it can happen that it reverses straight into a new trend from the breakout and retest phase, and that's why it's so important to look out for that phase 2, which is the trend confirmation phase. In any case, in the maturation phase, we are now expecting the market to still make new lows in terms of this downtrend, but now are probably going to be looking to pull back much deeper. And also we are expecting at this point to see the 50 SMA to start crossing over the 100 SMA. After another break lower, we'll see that the market now pulls back much deeper, and this is usually when we reach the exhaustion phase. And at this point, we can see that the market is mostly ranging sideways and typically not the best place to trade. What we will be looking for in market phase 5 is typically a break into a new trend, and that is phase 1 of the new trend. So just quickly looking at this last example, so we can see there we have our price breaking above the simple 200 moving average as it has done before. The difference being is this time we now have confirmation because we have the 50 moving in between the 1500 moving averages, and we are now breaking above market structure, confirming our breakout and entering into the breakout and retest phase. In this instance, we now can see our market is moving higher and it's then pulling back and then once again moving higher. At this point, we can see that we have now pulled back a bit deeper than we have done previously. And this means we are now entering the maturation phase where we do still expect the market to make new highs, but that means we are expecting the market to pull back much deeper than previously. And in this stage, you can see we did have a very deep pullback towards previous market structure, and that last stop was actually even a lower high, meaning the market was actually no longer able to make higher highs. Even though it did make a higher low, it did not make a higher high. And this point, we mentioned that we are looking for classical charting patterns and reversal patterns to get on board a new trend. So as identified, we then saw the market break below the 200 moving average. We saw the 200 moving average moving in between the 1500. We saw the break of that market structure then, and then we mentioned we expecting the price to move back to the lower end of that market structure and currently awaiting a pullback towards previous a previous market structure or one of these MAs, and you can see that it's so far what the price is indeed doing. So the important thing now would be, and perhaps just to recap, just to show you what we are expecting to trade in each of these market phases. So in market phase 1, we are looking to trade the break from market structure. So that would be that initial very strong break above the 200 simple moving average. So that would usually be a quick trade, but it's usually an aggressive trade, meaning once the market breaks through that 200 moving average, there is usually quite sufficient points to be made from that breakout. In the second phase, which is our confirmation phase, we are looking to trade the breakout again, but this time from the market structure, which will be leading us into the breakout and retest phase. Once we are on phase 3, which is the ideal phase to be trading in, we are looking to trade reversals from the previous MAs that it's pulling back to, or whether that be MAs or market structure, and you're then looking to trade that reversal towards a new high or low, depending on the trend, of course. In phase 4, which is the maturation phase, what we're now looking for is we're looking to trade reversals once again, but only after a structure break from one of those deep pullbacks, and then we are looking to trade that towards, again, a new high or low. Usually in phase 5, you would ideally not want to be trading, but because we are looking for classical charting patterns, and usually we're looking for either a top or a bottom in the market, you could identify one of those charting patterns and then use that to trade the breakout into the new initiation phase, which will coincide with the same trade as phase 1, meaning the break from market structure. Sticking with our Euro-U is the example. I'm going to move back towards the initiation phase of this last bearish trend. So what we noticed in this example is we saw quite a strong break below the 200 moving average. So typically that means that we have had a previous market phase, either 4 or 5. As I mentioned, not all trends will reach stage 5 or even stage 4, but once we have identified a top structure in the market, we are looking for that new initiation phase. So that is typically where you would be trading a breakout from below that 200 moving average. Usually it would be best to wait for confirmation of that break with a close below the 200 moving average. And in this stage, it's just a matter of determining your targets. Now, targets are typically best established using previous market structures. So you would typically just be looking left of your current position in the market. Previous areas of support would include this area over here. You can see this was quite a strong area of support, as every time the market came down into this area, we saw the market finding some degree of support on this area, meaning that break could have been used to trade towards that area. Of course, your stop loss would have been usually you can use something like an ATR indicator just to place your stop, one ATR above the high above that 200 moving average, so somewhere along there. As you can see in this instance, you did make a few points in that move, but do not try to trade that whole trend, as we never know at what stage the market will start to pull back. The next thing we are looking for as we approach phase 2 of our market is that crossover after 200 into the 50 and the 100. And once this happens, we are now looking again to trade the break in market structure in the direction of a trend. So the only time I can see this happening is either over here, we have highlighted this symmetrical triangle formation, and I'll just draw that out for you quickly so you can see how that looks. So you can see that's typically something like the symmetrical triangle, and we see the market break below that, meaning that would again be a good opportunity to take your short. And then same thing, we look back to see where was previous areas of support when the market came down. So you can see there was a small area of, let's just quickly put that in for you guys. So you can see over there is a doji. You can see the market pulled back down into that area, then reversed up. So that would have been a nice area to perhaps place your target. And that would have given you a move all the way down to there. If you were more conservative, you could have waited for a horizontal break below market structure. So you can see there was previous lows in this area over there. And once we broke below that area, again, that would have been your entry with your target over there. Just make sure whenever you do take a breakout trade that you do have a favorable risk to reward ratio. And what that simply means is that you want to make sure that wherever you place or enter your trade and wherever your target is, wherever you place your stop, that should at least be a 1-to-1 risk to reward ratio. So in this instance, you should have had a stop no higher than that area over there at the top of that rectangle. Now we are entering into phase 3. Phase 3 is where we're expecting the market to pull back and resume to make a new low in the instance of this bearish trend. So how this will typically work is you'll see the market starting to pull back, usually towards previous market structure or one of the MAs, so be that depending on how strong this trend is, be that the 21 EMA, this is the dark green line, or the 50 SMA that I have on here, the green dotted, the 100 SMA, and the blue dotted, or the 200 SMA. So typically we'll be looking for a rejection from one of these levels, or just from previous market structure. Market structure just referring to those swings in the market previously. So in this instance, we can see that after we had that pullback, we had a little bit of confirmation in this area on the 28th of August. And that could have been an example of a possible rejection. However, if you were to drill down to a lower time frame, it would be very handy to, of course, look for additional market structure confirmation in this area. So typically, if you were looking for the setup on a daily time frame, you would be drilling down to at least a 4-hour, ideally perhaps even a 1 hour to confirm that breakout. Let's drop down to that 4-hour time frame. So yes, there we are approaching that area now. So just looking at the lower time frame, you can see how the market is now pushing back up into those areas of previous resistance. We can see, looking at those swing highs, how that has been very strong areas of resistance previously. So looking at how that might play out. So already, sorry, I'm just going to pause that over there. We can see how the market pulled up into that area, immediately got rejected. It actually moved down to that 21 EMA, pushed back up, so it made like a mini top on this lower time frame. And then looking at just that last shadow of that candle, we can see, and just creating like a mini market structure over there. We can see how that last break then set this move lower into motion, and just playing that out, you can see how the market then continued to move down, testing the 100 SMA in this instance. So that's just one example of how you could use the lower time frame to best find those reversals. So every time the market pulls back into those previous areas of resistance, you would be looking for a reversal on the lower time frame. You can also use the moving averages as a guideline. For instance, in this case, the 100 working quite well, looking for and identifying those areas. Just briefly moving on to the market phase 4, which is the maturation phase. At this point, we are again looking for reversals, but this time we're looking for deeper reversals from previous market structure. So there we can see is a very strong area of previous support, which turned into resistance. And this is the area that we would be looking for rejection. There is also an area of rejection right over there on the 13th of December. So that is also something that might have been tradable. But of course, this would have been the best reversal where you'd be looking again on lower time frame on the 2nd of January for that move lower. And as I've also mentioned in our first part of this video, this is only a way to establish a bias, meaning once this occurs, we are looking to establish a bias of short trades. So if this happens, we are looking to trade short in the market until proven otherwise. In market phase 5, really not a great place to trade if this were to occur, and you would ideally only be looking for that final reversal from the downtrend to the uptrend, which is a market phase 1 initiation. It might have been an instance where this move on the 27th of March might have looked like a market reversal, but you can see that actually immediately failed. So as I've mentioned, you typically use a stop loss right below the 200 moving average. So if it fails, you're out of that trade. In this instance, you can see when it breaks through, it actually continues and commits to that move and continues to move higher. I'm not going to go through all of the phases for this bullish trend again. I think we did cover some of them in the previous video. But what I do like to look at is the most recent example, where we now currently have entered into market phase 3 in this downtrend, and we were looking for that break of market structure. And with this break of the market structure, the first thing we would have looked at is our risk to reward ratio. So in this scenario, it does not look like we could have really had a very favorable risk to reward ratio, as just looking back to our previous support, we know our target would have been over there. And even if we were to use a set entry for our break, you could see that it really would have been difficult to get a 1-to-1 or above risk to reward ratio. But that's not an issue, as we know that our best trade in this instance, and especially our market phase 3 trades, come from our reversal trades from previous market structure or one of our previous MAs. So we are now patiently waiting for price to move back into previous market structure, somewhere in the vicinity of, you can see this 1.88 level. We would have price being most likely rejected from either that 50 SMA or from that area where we have our previous shadows getting rejected. So now we are patiently waiting, and as soon as that happens, of course, we will be covering that with you guys in a new video. So please keep an eye out for that, and next week we will be looking at some other opportunities where we will be applying our trend evaluation method to find you the best setups. That concludes this 2-part series. Starting next week, we will be applying this method to identify the best setups on the market. As you know, we love to hear from you, so please support our channel by subscribing, and also remember to visit our website www.rmdtrader.com and shoot us a message with your feedback or questions. Until next time, trade smart and trade successful.